Market balance and imbalance in Forex. The basic pattern of the Forex market is balance, imbalance, balance, imbalance, and so on. It's very important to understand this, because is the market behavior of any currency, stock or commodity. The market trades between the established excesses until it either trades above the high excess, break out above the resistance level, or below the low excess, break out below the support level. Balance zone. If the market is balanced, as shown in the chart above, equal amounts of buying and selling are present. The price keeps moving up and down within a range, sideways, creating a distribution. Both parts are fighting with each other to control the market. Sometimes these ranges can last days, even months. Imbalance area. When buyers or sellers are in control, the market is imbalanced and will move in the direction of the leading players. If sellers are in control, the market will move down, and if the buyers take control, the market will move up. After a consolidation, we see these momentums that often are sharp moves. In the chart below, the rectangle shows balanced areas. These balanced areas are areas where both buying and selling activities occur at the same time, because both buyers and sellers are comfortable around this price range. Notice how price moves horizontally. Usually this zone can be called a value area, a concept from volume profile tool. Inside this zone is located point of control, that is the price level for the time period with the highest traded volume. Once the market moves from a balanced state to an imbalanced state, price leaves the area with large candles. This represents the imbalance, which means that one of the players exceeds the other. From the left side of the chart, sellers exceed buyers and prices dropped like a snowfall. The market then enters a balanced state, waiting for the price to take a directional move to either the upside or the downside area. Price went up, and we have a balanced area, and this is the process that repeats over and over again. Now, on the right side of the chart, the price dropped sharply and then continued dropping with small candles. This shows that the market participants are seeking a fair price for the balanced rotations to occur. This compress the price and make the fall more smoothly. The exceeded players are trying to gain strength, but not enough to balance the price. This is the general cycle of the market: balance, imbalance, balance, imbalance, etc. In supply and demand strategy, we focus on spotting these areas of balance. Because we want to place our order in these areas and profit from the imbalance that moves the price in a directional move, making a profit. This type of entry can put us in favorable position against the market, avoiding the large drawdowns in time and reaching our target more quickly. How to identify supply and demand zones? Simple answer: just look at the price action. We start by identifying the current price, then we look to the left until we find a big strong move up or down. Here's how you do it. Identify current price. Look to the left to find ERC in last drop or rally. In this step, we need to find an ERC type of candle. ERC simply means an extended range candle. It is a candle that has a large body and small or no wicks. Here's how an extended range candle type of candlestick looks like. Once we identify an extended range candle type, and we have either a drop or a rally in price, now we have to find the origin of that move. This origin will form the base of our supply or demand zone. Let's look at an example. In this example, we start at current price, and we look left to find a drop or a rally in price with at least one extended range candle type of candlestick. Once we identify an extended range candle, we identify the origin of the down move. The origin is what we call the base. The base is what we need to draw the zone. Now that we know how to identify supply and demand zones, we need to learn how to draw our supply and demand zones. The different structures of supply and demand zones. There are two types of structures or patterns that we need to learn: reversal and continuation patterns. Reversal patterns. These reversal patterns are chart patterns that are formed when the trend reverses from up to down or down to up. We have two structures. Drop base rally. In this structure, price is moving in a downtrend, creating a drop in price, followed by a base structure, then a rally in price to the upside. The reversal can occur very sharp, without consolidation on the top, as example on the left. The other type of base is when price spends some time in the zone, consolidating. Usually the second example represent the value area from volume profile principle. Rally base drop. In this structure price rallied up and creates a base structure, followed by a big drop in price to the downside. These reversal patterns are strong, and price tends to respect them. They are similar with double top or bottom regarding to chart patterns. Continuation patterns. These price structures are drop base drop. Price drops and forms a base structure, then continues moving down. The single base candle on the left usually can represent the higher time frame and the next example the lower time frame. For example, when we shift from daily to 4 hours time frame, the base zone represent the value area from volume profile principle. It can be in the shape of rectangle or pennant chart pattern. Rally base rally. Price rallies up and forms a base structure, then continues moving up. These continuation patterns are found inside the trend.